Good afternoon and welcome to the Real Vision Daily Briefing. I'm Andreas Steno from Real Vision speaking, and it's today, Wednesday, the 21st of December. It's been another great week in global macro, not least due to the decision taken by Bank of Japan yesterday. And today we're going to ask the question whether this decision from Bank of Japan is just a tempest in the teapot. I think that's a British saying, but I guess my guest of the day will get where I am going now. It's great to see you, Darius Dale, the founder of 42 Macro.
Andreas, it's great to be here, man. It's the last show of the year. Super excited to be with you all.
Darius, this decision taken by Bank of Japan, they obviously moved the trade range for the 10-year bond yield from minus plus 25 basis points to the double. So basically minus to plus 50 basis points instead. And we got a decent move in the Japanese bond space after that decision was taken. What do you make of it in a global context?
Yeah, so it's a lot going on. So from our perspective, the BoJ, led by outgoing Governor Haruhiko Kuroda, who's going to be his terms up in the spring of next year. It's our belief that what they're effectively doing is sort of twofold. One, acknowledging the fact that there's been some liquidity, significant deterioration in liquidity in the JGB market, and so allowing for a wider band of wider trading range to account for that. Obviously, the low liquidity tends to have higher realized volatility in prices, but more importantly, I think he's also, this guy's 78 years old, and he's sort of really the architect of this sort of, massive, forceful, quantitative and qualitative easing that we've seen out of Japan over the last kind of 6-7 years. And I think he wants to take a victory lap to some degree, right? You got inflation in Japan, and when you look at headline, it's running at 3.8% year over year. That's 180 basis points north of the target. You look at the BOJ's target, which is headline CPI X fresh food, at 360 basis or 3.6%, it's 160 basis points above the target. And so both of those are 3 sigma moves relative to the long-term time series. So he's tipping this cap to himself and saying, hey, look, we produced the inflation that we've been trying so desperately to produce. And so ultimately we can take our foot off the gas from the perspective of maintaining such a tight band and all the kind of bond purchases that they're likely to have to do to maintain that band. So it's a meaningful step, but I'm not so sure it's a material sea change in the Bank of Japan policy. We can unpack that as well.
Yeah, inflation is actually running above target in Japan now. This is truly a macro world upside down. We haven't seen that for many decades. But in any case, I wanted to ask you about the ramifications for the US Treasury market. We obviously saw a direct spillover on the day of the decision making of Bank of Japan. But today it seems like the market is calming down again. We've actually seen a slight retracement in dollar interest rates. We've seen positive equity markets today. So what do you make of the reaction today relative to yesterday?
Yeah, no, I thought the reaction to yesterday sort of led, in my opinion, to the reaction today, which is the toning down of interest rate volatility on the back of the initial move. I thought it was pretty telling yesterday that the BOJ 10-year couldn't even get to the 50 basis point upper boundary of that band, at least in the initial phases of the move. And so, in our opinion, there's clearly some demand out there for global sovereign debt securities on the long end as the world heads into what we believe is likely to be a globally coordinated recession commencing at some point in the middle of next year.
If we look at the move in FX space, dollar yen moved roughly 4% lower on the back of this decision from Bank of Japan. We've had a slight retracement higher again today. But if you look at the dollar move versus the yen, is this significant in a broader setting?
Yeah, I think it's very significant. So to me, the FX market is where all this is taking place in terms of like what the most material changes. Brian, if you thought that slide 12 that we sent you, where we show 2 of our 3 FX valuation models, and Japan, the Japanese yen, and what we're showing here is nominal effective exchange rates, the year-over-year rate of change in the y-axis in both of these charts. On the left axis, on the left chart is our monetary impulse model, which shows the year-over-year delta in the real interest rate, 1-year real interest rate. The y-axis or the x-axis in the right chart is our fiscal impulse model, where we show the deviation from the pre-COVID trend in the sovereign budget balance as a percent of GDP. And as you can see on both charts, Japan being down there at the bottom left of both charts, kind of decently away from the trend line, the regression line in the left chart, and very far away from the regression line in the right chart. It tells you that the Japanese yen is slightly undervalued on a monetary impulse basis and very undervalued on a fiscal impulse basis. And so there's a lot of net short positioning, latent short positioning in the currency market right now that we believe is likely to get unwound in the coming weeks and months as a function of this sort of change with respect to the outlook for BoJ policy. Again, I don't think it's a big change from a monetary policy standpoint, but it can be a big change from the perspective of a currency market that is leaning heavily net short the yen still, and in the context of an undervalued currency.
I think that is a spot-on assessment, Darius. If we look at the ramifications for U.S. Treasury, say 1-2 quarters ahead, what do you make of a Japanese central bank trying to move the needle upwards on the 10-year point while dollar yen is moving lower, so in the direction of a stronger yen? What does that cocktail tell you about the U.S. bond market?
Yeah, so let me before I answer your question, let me give you some more background on what this policy might look like, a couple of quarters from now. We have Governor Kuroda, who's his outgoing governor of Bank of Japan. He's likely to be out here. He's out of here in the spring. We know that. The two gentlemen that are sort of rumored to be in the driver's seat as it relates to replacing Kuroda, you have the current BoJ governor, Masayoshi Amamiya. He's very much on board with the extreme easing that we've seen in the Kuroda regime. So there's unlikely to be any material change there. There's also the former BoJ deputy governor, Hiroshi Nakaso, who actually recently authored a book about exiting from the ultra easy monetary policy that we've seen kind of in this Kuroda regime as a function of Abenomics. So he would likely represent a material change from the perspective of the forward outlook and Japanese monetary policy. So if we did see, again, this gentleman, Hiroshi Nakaso, become the primary candidate to replace Kuroda, we're going to see Japanese rates markets move to price in an even wider band and potentially a higher a structural upshift in the yield curve. That, with respect to the treasury market, has significant implications. Obviously, Japan being kind of one of the kind of leading anchors on global sovereign debt yields broadly, given the size of its market and then the pricing in this market, it's very likely that's going to have a material impact on the global treasury market. It's not just treasuries, obviously, German bonds, Italian BTPs, et cetera, et cetera, et cetera. The reason we're not so sure that that is likely to be the modal outcome is primarily based on our forecast for the global economy. So we'll start, Brian, if you throw up the U.S. grid model that we have on slide 75. What we do, I think, really well at 42 Macro, among the things we do well, is understanding, kind of projecting growth and inflation in delta terms across a variety of economies with, significant accuracy. And our model is suggesting that, by the time you get into the spring of next year, not only the U.S. economy, that's slide 75, slide 3, that's the Eurozone, slide 4 is Japan, and then slide 5 is the world. You can just flip through them, Brian. All these economies, all these major economies are going into deeper and deeper deflation. And what we call deflation, that's just a scenario, the condition where the growth dynamics are slowing simultaneously with the inflation dynamics. And so by the time you sort of Kuroda's leaving, whoever takes his place, whether it be Nakaso or Amamiya, it's very likely they're going to be sort of looking at a world that's slower than it is today from a nominal GDP perspective, but also starting to pick up steam to the downside as we head into a globally coordinated recession. It's unlikely that we see a significant amount of tightening out of the Bank of Japan or really any of these central banks beyond that point.
I tend to agree, Darius. And one thing I can add is that when the dollar strengthens materially as a consequence of a tight Fed policy and tight dollar liquidity, as we've seen this year, foreign FX reserves of US dollars also tend to lessen as a consequence of that move in the US dollar. We've seen that in Japan this year as well. They've defended the Japanese yen with the foreign exchange reserve to a certain extent. So if this move from Bank of Japan actually pulls the rug from under the trend that we've seen in dollar yen towards a stronger dollar, then it also makes the life easier for Bank of Japan in FX terms. And ultimately, that could actually open the door for them to buy US treasuries again.
What? Don't you have a chart on that? I saw one of your charts, man. You have a great chart on this.
Yeah. We can pull up chart 3 on that, Brian, from my perspective. I mean, it seems counterintuitive on the surface that you have this correlation between holdings of US bonds by Japanese accounts relative to the dollar versus JPY exchange rate. So what we have on the chart here is dollar JPY on the left-hand axis on a reversed scale. So every time we go lower, it means that we have a stronger US dollar, and it means that we have fewer holdings of dollar bonds by Japanese accounts. So it is how the correlation works in real life. As a consequence of the Japanese central bank being able to build FX reserves or not. It is the biggest buyer of dollar assets by the end of the day, and therefore it is so important whether the trend is up or down in dollar yen. And I think the trend is down now, which could actually bode pretty well for US treasuries into next year, which seems counterintuitive on the surface, I have to admit that.
No, I actually don't think it's counterintuitive, right? I mean, so when the yen is in free fall, obviously it's harder to buy dollar-based assets if the dollar is appreciating, kind of at a rapid pace relative to your base currency. But more importantly, you have a lot of pricing headwinds from the perspective of FX hedging and currency hedging instruments. And so, once you reverse all those things, the attractiveness of yields on an FX hedge basis become actually quite attractive. And so that chart makes a ton of sense from a fundamental standpoint.
Yeah, you're absolutely right. We need to look at yields in an FX hedge perspective. So what Japanese accounts like the most is a steep dollar curve. They want the 10-year point to be much higher than the 3-month point on the dollar yield curve, because that makes it attractive to buy the 10-year point and hedge the FX risk with this 3-month interest rate risk, as you usually do as an institution, for example, a pension fund. But I wanted to play a soundbite for you, Darius, from our colleague, Weston Nakamura in Tokyo. His point is that Bank of Japan finally leaves the era of free money, as well as all other central banks have done this year. So let's listen to Weston and get back to the discussion on the global ramifications of this move from Bank of Japan.
What are market participants saying? And how is this all being received? Well, there's a lot of opinions out there, but by and large, the nearly unanimous perception is simply this is a rate hike. And it's a rate hike in response to rising inflation in Japan. Despite BoJ saying this is neither a rate hike, nor do they foresee any more of these widenings of the yield curve in bands, nor that Japan CPI uptrend is going to continue higher, right? They project CPI to fall back towards 2% in 2023 from above the 3% current. And markets are still saying, nope, rate hike, and it's a rate hike due to Japan CPI. And the public market perception goes even further than that, okay? So this is not just a rate hike, or this is not just a not rate hike. This is the beginning of the end of this yield curve control experiment, and even further, it's the end of an era globally. This is the last major central bank who was left dovish against every other one of their peers, with the exception of the always, kind of idiosyncratic outliers, China, PBOC, and Turkey's CBRT. But, among the, quote, the normal major G5 open economy Western capitalist central banks, this is the first in / last out accommodative central bank. Finally caving to reality of Japan inflation is now here, it's on the rise, and unsustainable pressure on the yen. And so BoJ is finally capitulating to all of these forces. And the Bank of Japan is now joining the rest of the party, and this is now the official end of an era of free money globally.
The entire explainer on what happened in Japan is already available at the Real Vision platform today, and no one is better at unpacking the Japanese action than my colleague Weston in Tokyo. But back to you, Darius. Weston's point is basically that this is the ultimate end of free money globally. Do you agree?
Yes and no. So I got an interesting chart on that. So yes, I agree that we're moving in the direction of the ending of free money, but the money's not particularly tight by any stretch of the imagination, particularly when you look at some of these foreign central banks and foreign demographies. If you look at a slide, what slide is that? 73, where we show our Taylor rule spreads across the different geographies. So in this chart 73, the area under the curve there, and then the shaded areas in each of these panels is the spread between the 1-year sovereign interest rate on a nominal basis, minus the Taylor rule estimate for the policy rate for that geography. So the U.S. in the top panel, the Eurozone, ECB in the second panel, the UK and the Bank of England in the third panel, and then Japan and the BoJ in the fourth panel. And as you can see, even inclusive of all the policy rate tightening that is priced into those current sovereign debt curves over the next year, we're still talking about a minus 518 basis point spread for the Fed. We're talking about a minus 867 basis point spread for the Eurozone, for the ECB, a minus 1,008 basis point spread for the UK, and a minus 432 basis point spread for the BoJ. So money is still quite easy relative to this, big structural inflation shock. And in our opinion, at least according to our research at 42 Macro, the structural regime change we've seen, we've observed and continue to observe from a labor market and inflation standpoint in a lot of these geographies. And so ultimately, they're going to have to pick their poison next year, right? I mean, you're going to have to decide whether you want to, protect the economy and sort of migrate towards mitigating the left tail with respect to labor market outcomes, which obviously would kind of fan the right tail of inflation outcomes, or vice versa. You want to cut off the right tail of inflation outcomes and sacrifice the the left tail of labor market outcomes in that process. And so it's our belief that based on the Fed's guidance relative to the ECB's guidance and the Bank of England's guidance, is that the Fed is likely to be the one that's going to prove itself most hawkish in 2023, certainly relative to current pricing and asset market and money markets.
Darius, we can certainly use this chart as sort of a springboard to a discussion on the FX outlook into 2023. One thing is that we currently see a weakening trend in the US dollar versus both the euro, the sterling, and the Japanese yen. But I think if we look a bit beneath the surface, we have different positioning data across the currencies that we discuss, right? So the Japanese yen is very short, but it's not necessarily the case for the euro and the sterling. I know you have some views on that.
Yeah, absolutely. So the euro, I don't think I have a chart on this, but just off the top of my head, so the euro, one thing we track on a weekly basis in the CFTC data, I think you do as well, is the non-commercial net length as a percent of total open interest. So the euro positioning, and I think is at a plus 17%, which is a 17% net long position in the currency. That's on a 100 percentile basis with respect to last year, and I think it's in like the 77th or 80th percentile on an all-time basis with data going back to I think 1995. And so the market is extremely long the euro and betting on sort of Madame Lagarde and her colleagues' resolve in a way that they're not so willing to do with respect to the Fed. You have about two rate cuts priced into the Fed by the end of next year, while at the same time we have let's call it 105 or 6 rate hikes priced into the ECB curve in terms of OIS overnight index swap markets. The spread between those two, roughly around 170 basis points or so, is at an all-time high. The spread on the 2-year forward basis, I want to say it's like 200 plus basis points, which is also at an all-time high. So the currency markets, money markets in particular, have never been more convinced that the ECB is going to be more hawkish than the Fed on a relative basis over the next 1 to 2 years, and that's obviously very much reflected in the positioning data that we see. So it's our belief that the correction that we're seeing in the dollar relative to the euro is likely long in the tooth. Now, again, currency markets are, they're not all going to trade in the same uniform fashion that we've observed throughout the last kind of 12 to 18 months. You're going to see more dispersion, and I think you're going to see strong yen, perhaps even strong Swiss franc as you get further into 2023 vis-a-vis versus maybe weak dollar or weak euro, weak British pound versus the dollar.
Rate hikes from the European Central Bank while the Federal Reserve cut rates. That's an interesting mix. I mean, I think that can only happen if Christine Lagarde is asleep at the wheel.
Yeah, that happened 2 times, 2008 and 2011. And how'd that end up for Europe?
Let's put it like this, thumbs down. So, I mean, I've noticed this as well, and the only thing I can use to defend the current positioning of markets that the ECB can hike for longer and that the euro will gain versus the US dollar is that the inflation picture in Europe tends to lag the inflation picture in the US by a couple of quarters. So it will probably take another say 3 to 4 months before the European Central Bank actually realizes that inflation is also heading lower in the Eurozone. But ultimately, I perfectly agree with your take that this is a tremendous setup to short the euro versus the dollar. And that leads me to talk a bit about 2023, Darius. Yeah, please chip in.
Oh yeah, I just had one quick thing. I think you're spot on with respect to the lag in core inflation dynamics in Europe relative to the U.S. But one thing I think is different as of last Wednesday is the Fed pivoted. The Fed pivoted to an incrementally hawkish stance by upgrading the labor market in its reaction function and downgrading inflation. And so now we're no longer comparing, in core inflation dynamics to core inflation dynamics on an apples to apples basis. It's now apples to oranges. And so I have a few charts just to quickly go through on the labor market in the U.S. to remind everyone this is what matters. And so on slide 19, where we show this sort of post-COVID reduction in labor supply, which is increasingly permanent. The top panel shows the employment to population ratio. The second panel shows the labor force participation rate. The third panel is the labor force participation rate for 55-plus-year-olds. And the bottom panel is the labor force participation rate for females here in the U.S. And we're down 130 to 160 basis points. Pick your indicator. 130 on the headline numbers. And if you check that over to slide 20, where we show sort of kind of our composite of private sector labor income, which was the product of private sector employment. We'll be looking at the mean of payrolls growth in the private sector between the household and payroll surveys to account for the fact that there's a lot of dispersion in those two statistics at the current juncture. Private sector average hourly earnings, private sector average weekly hours, and you're talking about private sector labor income as of November is growing at 6.6% on a 3-month annualized basis, which is 50% higher than the pre-COVID trend. And so now the Fed has basically upped the ante on the statistics that it's looking at to guide its reaction functions. So that, in our opinion, I think the market is sort of thinking, hey, look, the ECB is just, 3 quarters behind the Fed in terms of all the tightening that it has to do. Well, the Fed actually just kind of put an additional lag on itself. So maybe the ECB is only 1 quarter behind when you factor in this lag.
That's a really fair point, Darius. I wanted to move the discussion towards the outlook for 2023, and please keep the questions coming out there. We have a bunch of questions coming already, but this is the last time you get the chance to ask Darius a question, at least on Real Vision, before New Year's. So, Darius, 2023, from a big picture macro perspective, what are going to be the major trends that you're watching?
Oh, great question. So this has been the focal point of our research for the past few months, is trying to identify the timing associated with the end of the phase 1 liquidity cycle downturn that we are already in, that we all sort of observing ourselves. That's caused a lot of pain for a lot of investor portfolios. You got the S&P 500 down 19% year to date, the Nasdaq's down 31%, TLT's down 30, Bitcoin down 63, Ethereum down 67, and that was all, in our opinion, at least according to our research, due to the phase 1 liquidity cycle downturn. Bear markets always have 2 phases, or at least the ones that are associated with recessions. Not all bear markets are associated with recessions, but the ones that are, and we obviously believe that there's likely to be a recession at some point commencing in the next 12-month time horizon, both US and global. There's going to be a phase 2, which is the credit cycle downturn, the pricing in of the actual recession. In fact, we have a great chart on this on slide 66, Brian, where we show that the asset markets have not priced in that phase 1, that phase 2 yet. And so what we show here in this chart is in the first panel, the Goldman Sachs Financial Conditions Index. The second panel, we show the S&P 500's next 12 months earnings yield, so earnings divided by the price. And then the third panel's then U.S. dollar investment grade credit overnight, option adjusted spreads. And then lastly, the high beta, low beta ratio for securities in the S&P 500. And as you can see, based on those dotted lines, which correspond to the peak and or trough of the 2001 recession, 1991 recession, 1990-91 recession, and the global financial crisis, and ultimately the mean of those 3 peaks and troughs, we are nowhere near pricing in a recession through a variety of key financial metrics. And so it's our opinion that phase 2, which is yet to begin, is ultimately going to be the kind of the final leg down, that second leg down phenomenon that we always talk about in financial markets. So going back to answer your question really succinctly, it's the number one thing we're focused on in our research is trying to identify whether or not phase 1 and phase 2 are spaced apart. If phase 1 ends, let's say, kind of Q1 of next year, and the recession doesn't start into Q4, you could have a multi-month or even multi-quarter period of time for asset markets to reprice higher and kind of crush a lot of this sort of latent short positioning before investment markets have to begin pricing in phase two. If, however, the recession starts sooner, which is obviously a lot of the focus of a lot of our research here for macro, if it starts sooner, both domestically and globally, you might actually have phase one and phase two bumped up close to each other, which means you're going to begin pricing in the phase two credit cycle portion of the bear market, from the lows of the phase one portion. So, just in terms of valuation work, and I know it's a long-winded answer, but I think it's a worthwhile answer. If you go to slide 38, Brian, where we show the S&P 500's price to next 12 months earnings ratio, far back as we can get the data, so we're, I think we're somewhere around 18-ish, 18 times-ish, to get back to a median price to next 12 months earnings ratio, you're talking about 3,600 on the S&P. That makes sense in the context of the phase one liquidity cycle downturn. If you go to slide 41, Brian, these are, and by the way, these are all charts from our December macro scouting report. We put out a presentation like this every month for our members at 42 Macro. If you look at on a price to next 12 months sales basis, we're talking about going down to 2,800. That's the kind of price level we would target if phase one and phase two were back to back. If they're spaced out, you might go to 3,600, rally back to 4,100, and ultimately get down to 3,600, 3,500 again. But if they're close together, then you're talking about something sub 3,000 on the S&P.
Darius, we get a bunch of questions on the ramifications of the potential government spending bill. We got the news yesterday about a 1.7 trillion package from the US administration again, and a potential timing of that bill in Q1 next year. Is that something that could alter this recession picture for next year?
I have to do more work on that, so I don't want to I don't want to speak out of turn with respect to the answer. We've already known that we were going to see more spending in the U.S., and at least with respect to the phase one liquidity cycle downturn, it's going to cause it to be worse. We're going to see obviously an increase in treasury supply. If they get that spending bill passed, it's going to be in conjunction with an increase in the debt ceiling. And so we're going to start to see, more than likely start to see an increase in the Treasury General account balance as well, which will be a direct drag on net liquidity. So that, in our opinion, at least in the early part of next year, it's not so great. Obviously, if they get through 1.7 trillion spending, and that's a significant delta relative to what we saw in fiscal 2022, then that would be positive and potentially could stave off, the pricing in phase two and ultimately the timing of a recession, into late 2024, maybe, or so late 2023, or maybe even early 2024. I don't know. I have to actually get the numbers on that.
Yeah. Within this bill, we have more aid for Ukraine, emergency disaster assistance, another package for the mitigate, and so on. So, it's a broad range of initiatives, and not all are clearly linked to 2023, and not all are clearly linked to US soil. I would just add that. But let's get to the next question, because Paul, one of our loyal members, asks a great question ahead of 2023. Goldman Sachs published a 2023 outlook labeling commodities as the best asset class to position in ahead of the year. And they also look for Brent crude at $105 a barrel already during Q1. What do you make of that outlook from Goldman Sachs?
I think it's reasonable in the context of something we have not talked about yet, which is the kind of China reopening thing. Which, in my opinion, I think we've done a good job of helping investors contextualize the fact that, hey, look, China reopening is not this immediate positive signal, right? You're going to go from no one having COVID in China to 1 billion people having COVID, so that's obviously not a positive shock to growth in this very near term. But also in the context of this phase one liquidity cycle downturn that we're in, that obviously is being perpetuated by the Fed, the ECB, the BoJ, the Bank of England, other central banks as well, because China, kind of is the victim of the impossible trinity of macroeconomics. They really do have to import a lot of monetary policy, U.S. dollar monetary policy from abroad, and so we've seen some reasonable degree of tightening when you look at the fluctuations in 3-month Shibor, Chinese capital outflows, et cetera, in the recent months. And as a function of that tightening we've seen a negative inflection in the Chinese credit impulse, which ultimately is a leading indicator for Chinese growth. We saw some pretty rancid numbers in the month of November, and obviously we expect that to continue throughout the next at least a couple of months. But when you get into late Q1, maybe even early Q2, you're going to see a Chinese economy that looks a little bit different. And I wouldn't necessarily say markedly different, but certainly should look delta positive relative to where it is today, and that's positive for commodities. I want to say China's crude oil imports are tracking down about 12%ish so from the highs. Copper imports are down about 15-20% from their highs. So this is a Chinese economy that just hasn't really moved from a commuting and traveling perspective, and probably, and as a function of the tightening we've seen in the real estate market over the last 2 to 3 years, probably has not been building as much as they used to as well. So I can see the commodity story really kind of catching hold after a pretty significant correction in 2023. But I wouldn't necessarily put it atop your best place to be from a risk, certainly not from a risk adjusted basis. Risk adjusted, I mean, it's going to be hard to beat 4 or 5% yields on T-bills and maybe even the long bond at some point starting in maybe second or third quarter.
Yeah, tend to agree, Darius. And finally, I wanted to pass on the greetings from one of our listeners, Mr. Wonder. He is writing here, Darius and Andreas, thank you for everything you do to help us all. Merry Christmas and Happy New Year. And I can only say likewise, Mr. Wonder. I hope you get a great holiday season with your family. Darius, a great pleasure to host you once again. To sum up today's discussion, even if Bank of Japan's decision to move the needle in the yield curve control is not a nothing burger, it is not necessarily a bad thing for U.S. Treasuries. I think the two of us agree on that. And that's at least one of the trends that we need to watch into 2023, whether the U.S. Treasury market starts performing as a consequence of the global trends that we see in macro. And otherwise, what you need to watch in 2023 is the timing of the actual recession, because that will dictate a lot of your asset allocation. Is that right, Darius?
Yeah, absolutely, man. That's a great summary, man. And if I can just leave you before your vaunted meme, which I laughed out loud when I saw it in my email earlier. Most people don't laugh out loud when they say LOL. I actually did LOL to that one, so that was good. But before we even get there, I just want to say thank you to everyone viewing, everyone who's watched these programs all throughout the year. It's been a fantastic opportunity to educate and help, grow the acumen and intellect and ultimately the trading ability of the global audience. And I just wanted to say thank you, man, for hosting. You're a wonderful host. Brian, Nick, you guys have been fantastic on the control board, Claire, et cetera. Maggie, Weston, and obviously a big thanks to Raul Paul. I mean, the guy takes way too much flack on Twitter. There was a time in my career, which wasn't very long ago, where institutional world-class research, macro and otherwise, was simply not available broadly. You just couldn't get access to it. And Raul Paul, went out on a limb, guy who's made millions and millions and millions of dollars from Man Group, one of the best hedge funds in the world, and actually say, you know what, I think there's an opportunity here to educate the masses. And guess what? He's doing that, and I'm very grateful to contribute to his vision. And just want to say thank you, Ralph, and thank you everyone to Real Vision.
Word, Darius, thank you very much. And best wishes for the holidays to you and your family as well. I wanted to conclude today's discussion with a meme as always. And this time it's a cat meme. Stop what you're doing. The JGB curve is moving 10 basis points. And I mean, that's what I always find hilarious about moves in Japan. They are so tiny in comparison to what we've seen in the US and Europe throughout this year. But as soon as the Japanese curve moves 10 basis points, we all stop what we're doing for some reason. But in any case, it's not a nothing burger, but it may not be bad news for the US Treasury market. I'm Andreas Steno. Thank you very much for watching the Daily Briefing. See you again tomorrow.